Hi everyone and welcome to this video where I'll be sharing with you some tips I've learned as a financial coach on how to make smart investments. Investing can seem daunting, but with a bit of financial education and research, it can be an excellent way to grow your wealth and retire early. Let's get started. Tip number 1. Understand your risk tolerance. Before making any investments, it's essential to determine your risk tolerance. Risk can be thought of as the probability of losing money from a given investment. There is almost always an inverse relationship between risk and the potential for making money on an investment. With that said, you have to ask yourself, how much risk are you willing to take on? Are you comfortable with the possibility of losing some or all of your investment capital? Knowing your risk tolerance will help you choose investments that align with your goals and comfort level. As a general rule, younger people tend to take on more risk because they have more time before they need to retire. If they end up losing a bunch of money, they have time to replace it before they actually need it. The opposite is true of people who are closer to retirement age. That's why if you went to a financial advisor for help with managing your wealth, they will usually have you invest more in stocks and mutual funds, which have a higher potential to increase and decrease in value over time, the younger you are, and slowly switch you over to more and more bond funds, which fluctuate in value much more slowly over the long term, as you get older. Tip number 2. Diversify your portfolio. Diversification is key to smart investing. It means spreading your money across different types of investments to reduce risk. Don't put all your eggs in one basket. Invest in a mix of stocks, bonds, real estate, and other assets to protect your portfolio against market volatility. Most financial planners will have you split your investment capital between funds by different business categories and even by geography. One thing that's worth noting is that they typically only handle one asset class though. Paper assets are great for saving for the future, but there are other asset classes such as business ownership, precious metals, and real estate investment for creating passive income streams or protecting your purchasing power when inflation gets out of control. Tip number 3. Start investing as early as possible. The earlier you start investing, the more time your money has to grow. Time is your biggest ally when it comes to investing, and even small amounts can make a big difference over the long term. The most common strategy is to use dollar cost averaging by setting aside a set amount of money every month or year to dedicate for investing purposes. You could use your annual tax refund, or work a side hustle for the extra money, or you could participate in a 401k with an employer match to accomplish this. The important part is to start and not stop. Tip number 4. Research your investments. Never invest in anything you don't understand. If it's a company, how do they make money? How long has it been running successfully? What is the track record of the people running it? Every time I've ever lost money in an investment, it was because someone I trusted with my money failed to do what they said they were going to do. Tip number 5. Stay disciplined. Smart investing requires discipline. Stick to your investment plan and resist the urge to panic sell when the market dips. Stay focused on your long-term goals and avoid making impulsive decisions. Tip number 6. Seek professional guidance. Investing can be complicated, and it's okay to seek professional guidance. A financial coach, for example, can help you create a personalized investment plan based on your goals and risk tolerance. They can also provide ongoing support and advice to keep you on track. A financial planner is similar, but they get paid based on what types of investments you make, so their advice may not always be what's best for your specific situation. A coach gets paid to provide education, so they don't have commissions and quotas to cloud their advice. Tip number 7. Monitor your investments. Investing is not a one-and-done deal. It requires ongoing monitoring to ensure your investments are performing as expected. Regularly review your portfolio and make adjustments as necessary to keep your investments aligned with your goals. No one will ever care more about your money than you. Tip number 8. Don't let emotions drive your investment decisions. Fear and greed are the two emotions that can drive investment decisions. Avoid making investment choices based on these emotions. Instead, focus on the facts and keep your emotions in check. Always let the numbers decide for you. Tip number 9. Consider tax implications. Investing can have tax implications, and it's essential to consider these when making investment decisions. Consult a tax strategist to determine the tax consequences of your investments and how to optimize your returns. Tip number 10. Be patient. Finally, remember that investing is a long-term game. Don't expect to get rich overnight. It takes time and patience to see significant returns on your investments. Stay focused on your goals and stay the course. And there you have it, 10 tips on how to make smarter investments. Investing can be intimidating, but it doesn't have to be. Just like when you were learning how to drive, it got easier the more training and practice you got. By following these tips and seeking professional guidance when necessary, you can build a strong investment portfolio that will help you achieve your financial goals. Thanks for watching. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to our channel for more financial tips and advice. If you'd like additional help, see our links in the description for free resources, books, and even one-on-one coaching where I share what I'm investing my own money in. See you in the next one.